Cadence just signaled the start of the agentic AI supercycle. And with an $8 billion backlog, it's not just participating, it's positioning to dominate. Let's break down what Q1 2026 really tells us. In this deep dive, we'll analyze the Q1 financial scorecard, the catalyst behind that massive backlog, the milestone of entering Rule of 60 territory, and a final reality check on the risks you need to monitor. Cadence just delivered a flawless quarter. Revenue surged 19% to $1.474 billion, beating street estimates. With record margins and an aggressive raise to full-year guidance, the company is firing on all cylinders. Let's look at the hard data. Total revenue hit $1.474 billion. Non-GAAP EPS rose nearly 25% to $1.96, and operating margins jumped 300 basis points to 44.7%. Every major metric was a definitive beat. Diversity is strength here. Core EDA software brings in 71% of revenue, while system design adds 15%. The fastest-growing segment is semiconductor IP at 22% growth, driven by critical AI infrastructure like HBM and PCIe. The big shift is from traditional software to autonomous agentic AI. Through the agent stack framework, Cadence is enabling massive scale in chip design, which drives premium pricing and higher compute consumption.
Why does Cadence trade at a premium? Because they command the high-margin upper layers of the AI tech stack. They sit right above the hardware foundation, owning the critical simulation and agentic AI growth engines. While the Rule of 40 is the gold standard for SaaS, Cadence has smashed through to the Rule of 60. By combining 17% growth with 44.7% margins, they reach a staggering 61.7% efficiency score. Cash is king. Cadence generated $356 million in operating cash this quarter. After CapEx, they had $307 million in free cash flow, with $200 million already deployed for share buybacks to reward investors. They aren't just in the digital world anymore. The Hexagon D&E acquisition expands Cadence into structural dynamics and robotics, narrowing the gap between digital simulation and physical reality. The upside is fueled by agentic upselling, record hardware margins of 88%, and massive pricing power. Plus, the Americas remain a powerhouse growth engine, driving 45% of total revenue. It's not all perfect. We have to watch the risks. Stock-based compensation is projected to hit $569 million, outpacing revenue growth. We also see a significant jump in payment collection times, with DSO moving from 44 to 67 days.
The bottom line, Cadence is showing flawless execution and elite financial health. Agent Stack secures their AI dominance, but keep a close eye on rising employee compensation costs and those expanding DSO numbers. Now we want to hear from you. Is Cadence the safest way to play the AI supercycle, or are the risks too high? Drop your thoughts in the comments. If you found this Cadence earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.